Silver just did something that should scare anyone who still thinks this shiny metal will always be cheap. During quiet holiday trading, the price didn't just move, it shot up fast in Asia, then dropped back down hard in crazy waves, like the market was trying to shake people off a wild ride. And while everyone was watching the price charts, the real event happened quietly. Governments and huge companies are secretly treating silver like an important resource they need, not just a shiny hobby. I'm your host. Welcome to our channel. Now watch this, because the story isn't that silver went up. The story is that the supply is getting tighter. The real metal market is getting louder, and the paper market is getting weaker every week. This is educational. We manage risk. Let's start with the part most people miss. When prices jump up, the internet yells bubble. When prices drop, the internet yells crash. But the smarter signal isn't the big headline. It's who is quietly changing what they do underneath the headline. And right now, behavior is changing. China is moving to block silver from leaving their country. The US is treating silver as critical. And big manufacturers are acting like they expect shortages, not extra supply. That's not drama, that's real business. Here's the mistake most people make. They look at silver like it's one market. It isn't. Why paper price can fool you. There's the paper market, where contracts trade like game tokens, and there's the physical market where real metal has to exist, get shipped, get insured, get cleaned up, and actually arrive. The paper market can create endless fake claims. The physical market can't create real metal out of nothing. So when the two disagree, we don't ask which chart looks prettier. We ask which side has to deliver real metal, because delivery always wins in the end. Now, what actually happened this week? Silver jumped higher during Asian trading hours, hit a fresh high price, and then got hit with sharp selling. That looked less like normal profit taking and more like a weapon to create chaos. If you've ever watched a door get slammed in a crowded room, you know the feeling. 1 second it's open, the next second it's chaos, and everyone pretends they didn't push. That's what this looked like. And here's why we care. This type of price action, especially when it happens when few people are trading, often shows stress. Not in the metal, but in the system. So let's look at the system. One of the loudest signals in any commodity rally is when futures participation doesn't T-grow with price. Because in a typical speculator rally, open interest balloons. More gamblers show up, more borrowed money piles on. The market turns into a crowded elevator. But when price rises while open interest fades or stays small, it suggests something different. Shorts are backing off. Weak hands are getting forced out, and the move is being driven by physical tightness, not paper enthusiasm. That matters. It means the rally is less party and more pressure. Now add in the inventory story. Across the major Western storage places, the publicly watched available piles have been getting smaller. The exact labels differ by location, but the pattern is the same. Metal that can be taken is getting taken. And when available inventory shrinks, the market's tolerance for games shrinks with it. Because if you can't easily find bars of silver, you can't easily fix problems. You can only delay them. And delays are where squeezes are born. Now, before anyone gets reckless, let's separate fact from guess. The physical market signals we track. Fact. Inventories that are watched by traders have been going down in recent months. Interpretation. That drawdown increases weakness and raises the cost of keeping short pressure going. That's the certainty ladder. We don't pretend to know the future. We measure. So why are inventories being stressed in the first place? Because silver demand is no longer one story. It's multiple huge trends stacked on top of each other like weight plates. Data centers, AI buildouts, electrification, solar expansion, bringing factories home, grid upgrades, defense tech, and yes, batteries. Every one of those themes touches silver. Sometimes directly because silver conducts electricity, sometimes indirectly because silver sits inside the connectors and control systems that make modern infrastructure work. People love to argue about ounces per device. They miss the bigger picture. This isn't one device. It's an entire civilization rewiring itself. That's why silver doesn't need a perfect storm. It just needs the storm we're already in. Now let's talk about the metals war idea. Call it competition. Call it national security. Call it supply chain strength. The label doesn't matter. What matters is the behavior. Countries want more control over inputs. Companies want more certainty over raw materials. And both sides are willing to pay for it. That's the part that breaks old models. Old model, price is low, supply is plentiful, buyers are relaxed. New model, supply is tight, buyers get nervous, and nervous buyers change the rules. You see it when restrictions appear. You see it when strategic lists get updated. You see it when money gets put into mines, not because mines are exciting, but because mines are permission slips. Here's a concrete example of the behavior shift. When a manufacturer takes a stake in a mining project and secures rights on future output, that's not a trade. That's a supply chain defense. They're saying, we don't trust the market to be there for us later. And once big buyers start thinking that way, the market stops being a smooth river. It becomes a series of dams. And dams don't fail gently, they fail all at once. Now, let's go east. China is the center of gravity for industrial metals demand. Policy shifts changing silver's role not because of a meme, because it makes the stuff the world runs on. If domestic inventories are small compared to industrial needs, then any policy move to keep material at home becomes a massive signal. It tells us one thing: they're not planning for abundance, they're planning for tightness. And when a country that sits at the heart of manufacturing chooses China first on a key input, the ripple goes everywhere. Suddenly the same bar gets bid by more people, suddenly premiums appear, suddenly delivery times get longer, and suddenly the paper price becomes less believable as a single truth. Now let's talk premiums, because this is where reality leaks through. Premiums are the voice of physical markets. They are the whisper that becomes a scream. If someone is offering extra money above spot to lock in supply, that doesn't mean price will moon tomorrow. It means the metal is harder to find at this price right now. And when you hear reports of overseas buyers calling producers with big premiums, that's not a chart pattern. That's a buying pattern. Buying is ruthless. Buying doesn't care about your technical indicators. Buying cares about not shutting down a production line. If a factory stops because a small input isn't available, the cost is huge. So they pay up. That's why small premiums can be the early tremor of a much bigger move. Now, watch the contradiction that keeps the public confused. The mainstream story says the dollar only slipped a little, but measured against hard assets, purchasing power can fall much more because inflation isn't one number. It's a map. Some things rise slowly, some things explode, and the things tied to real limits, energy, metals, shipping, often show the truth first. So, if your income is flat in dollar terms while metal prices surge, you didn't lose because you did something wrong. You lost because the measuring stick is bending. That's why people feel crazy. They're told the problem is small. Then they go shopping and feel the problem is huge. Now here's where we need to stay grounded. Price in a bull market can still be brutal. Silver is famous for it. It runs like a thief, then trips the alarm, then sprints again. It doesn't climb a staircase. It climbs a ladder in a windstorm. So, what do we do with that? We don't gamble. We position. We industrial demand pressure what's speeding up. Also separate time frames. Short term, crazy price swings can wreck borrowed money traders. Medium term, physical tightness can keep pressure on supply chains. Long-term structural demand can reprice the entire metal. If you're watching the 1-minute chart like it's a heartbeat monitor, you're going to panic. If you're watching the structural picture, you're going to think differently. Now, let's hit the Western storage story again, because this is where the tension lives. When monitored stockpiles shrink, lease rates tend to rise. And rising lease rates are a sign that metal is becoming more expensive to borrow. That matters because the bullion ecosystem relies on borrowing. It's a carry trade, a pipeline, a chain of promises. When borrowing gets costly, the chain tightens. When the chain tightens, the market becomes less tolerant of short games. And when tolerance disappears, you get violent moves. Not because of Reddit, because of math. Now, let's talk about the other white metals for a second, platinum and palladium, because they're telling us something too. When multiple related metals surge, it suggests broader pressure in the complex. Industrial demand, substitution, limited supply, or all of it at once. And when a metal like platinum can swing wildly within a single month, it reminds us of a truth. These markets are thinner than people assume. Thin markets don't need big news to move, they need imbalance. And right now, imbalance is showing up more often. Now, I want to address the EV story carefully because this is where hype and reality get tangled. There are claims floating around about silver content per battery. Some are exaggerated. Some are possible in specific designs. Some are just clickbait. We don't need the extreme number to make the case. Here's the smarter way to think. Even small increases in silver use per unit multiplied by massive scaling in production can move demand in a metal that already runs tight. 1 gram times a billion units is a mountain, and modern industry builds in billions. That's the frame. So when you see a tech shift that uses a little more silver, don't dismiss it. Ask how big is the scaling curve. Because scaling is where the hidden demand lives. Now let's talk about the US treating silver as critical. When something gets labeled critical, it's a policy signal. It means supply risk is being recognized. It means getting supplies from home becomes politically valuable. It means stockpiling becomes more likely. And it means competition for supply can get stronger, not overnight, but steadily. And steady pressure is exactly what turns a normal market into a stressed market. Now here's a thinking beat, because I want you to think, if silver is just a commodity, why are governments acting like it's strategic? And if it's just a store of value, why are manufacturers trying to lock it up? Which one is it? It's both. And that's why this setup is dangerous for anyone short and interesting for anyone watching the physical side. Because what premiums and tight supply behavior suggests metal that is both money and industrial has 2 engines. When one engine cools, the other can still pull. That's not a guarantee of higher prices. It's a structure of strength. Now, let's talk about the sentiment whip. This week, we saw the classic pattern. A surge that triggers headlines, a drop that triggers fear, and then a conversation that splits the crowd into two camps. Camp A says it's over. Camp B says it's just starting. Here's what we do. We don't pick a camp based on feelings. We pick signals based on evidence. Signal 1, policy moves that block or prioritize supply. Signal 2, manufacturers locking in mining exposure. Signal 3, monitored inventories going down. Signal 4, physical premiums and borrowing costs rising. Signal 5, violent price swings in paper markets during thin trading. When multiple signals stack, the odds of a sustained structural story increase. Not certainty, odds. Now, I want to address the celebrity tweet effect because it matters in the real world. When a major public figure touches a commodity story, it can change attention. Attention can change flows. Flows can change price, especially in a thin market. But here's the catch. Attention is a match. Structure is the fuel. A tweet can light something, but only tightness can keep it burning. So if you see social chatter explode, don't assume it's the reason. Assume it's a spotlight. Then look for the underlying fuel, supply, demand, inventories, premiums. That's how we stay sane. And speaking of staying sane, if you're thinking about putting money into metals, there's one rule we keep repeating. Don't use borrowed money you can't emotionally survive. These are not smooth markets. These are markets that test belief by attacking your nervous system. Now, let's get practical. What are the takeaways we actually need? First, silver is being pulled in two directions at once: money demand and industrial demand. And that makes its balance sheet more sensitive to shocks. Second, policy and corporate behavior are shifting towards getting supply locked down, which tightens the pipeline even before the public notices. Third, monitored inventories and borrowing signals suggest the physical side is not as loose as the paper side wants you to believe. Fourth, crazy price swings are not a sign the story is dead. In silver, crazy swings are often the price of admission. That's it. We don't need 20 points, we need the right few. Now let's talk about what to watch next, because this is where we gain edge. Watch physical premiums in key regions. If spot dips and premiums stay stubborn, the dip is probably paper-driven. Watch inventory reports and the pace of withdrawals. A slow grind lower is one thing, a sudden speed up is another. Watch policy headlines around export. The crazy price swing trap, most people fall into controls, strategic reserves, and critical mineral frameworks. Those are not opinions, they are levers. Watch corporate deals in mining, offtakes, royalties, equity stakes. Companies don't do those deals for fun, they do them because they're nervous. And watch the ratio between gold and silver, not as a magic number, as a feeling gauge. If silver outperforms hard, it signals a market that is starting to price industrial tightness plus money interest at the same time. Now, before we end, I want to pull you into the room with us. We're not here to be cheerleaders. We're not here to be doomers. We're here to be prepared. So here are two questions for you, and I want you to answer them in the comments. First, do you think governments will eventually treat silver like a restricted strategic material the way they treat certain energy inputs? Yes or no, and why? Second, if the paper price drops again next week, what would you watch first to decide if it's real? Premiums, inventories, or policy headlines? And now the call to action. Keep it simple. Subscribe, because the next move in this metals war won't come with a polite warning. Here's the line we keep repeating in our community. We're not gambling, we're measuring. If supply tightens, we expect stress. If stress rises, we expect crazy swings. If crazy swings rise, we expect opportunity, but only for people who planned before the crowd arrived. One more thing. The most dangerous moment in a tightening market is when everyone thinks it's back to normal. That's when the supply chain gets comfortable. That's when the shorts get brave. That's when the next shortage punch lands. And we're walking into a new stretch of trading where thin trading, policy shifts, and physical demand can crash together again. So don't watch the chart like it's entertainment. Watch it like it's a weather map because the sky is getting darker. And the next headline won't be silver is volatile. It'll be silver is unavailable. And when that happens, the price won't ask for permission.